Jeannie, it's great to have you joining us at NASDAQ today. Thanks for taking the time to be here. And obviously you've just sat on a panel focusing on what are the real energy investment opportunities over the next couple of years on both the public and the private side. A good discussion, good group of panelists. So maybe just summarize for us feedback, sentiment from that panel. Sort of what are your views on the current state of the oil and gas industry, and how are investors in the space feeling right now? Are they cautious, optimistic? What does it look like for the next few months and years?
Well, first of all, great event. Thank you for having me back here. I always enjoy the Energy Council because you get a great pulse on the sector with, fellow colleagues. So we all know that this is a very capital intensive sector, energy in and of itself. We also know that oil and gas in and of itself is on a different projection of the maturity cycle, right? So we're much more mature than we were 10 years ago. And so weighing the type of capital that needs to come into it versus 10 years ago when it was risky capital, I think is very important. We have different cash flow models that we're competing with. These are healthy cash flow companies, but we're also competing for public capital from banks, capital markets, et cetera. And so I would say, what's the sentiment? With investors, it's emotional. They lost a lot of money in the last decade. ESG is a factor. They have personal opinions on the sector versus maybe real estate. It doesn't have that tug when I go talk to an investor. So it's emotional. And so I would say, when we're talking to investors, when we're talking to companies, the need for capital is real. It's practical. We've got to provide solutions. But also when we're talking to investors, the need for returns is real. And the need to have that capital coming back at a healthy rate and at a healthy point of return is very important.
Great. And we've obviously seen trends around fundraising, capital formation this morning. The last few years, we've experienced this unprecedented outflow of capital from the sector. It's as tough a fundraising environment, or has been, as most people attending today will have ever experienced. While the number of private equity firms participating in energy has declined, along with the amount of capital available to these firms, the opportunity set, I think we're hearing today, and we've seen in articles and headlines over the past few weeks, remains robust. So where are the most attractive investment opportunities across the North American E&P landscape? And sort of what are the opportunities that have the ability to generate the types of risk-adjusted returns that you are expecting and your investors are looking for?
Well, first of all, I think origination is incredibly important. You have to be able to originate good, and I focus on direct lending, so good credit investments. I think that's key. We've seen a ton of consolidation. So again, last year, I think we spoke about this on the panel, but $120 billion just wrapped up in 2 deals, the Exxon Pioneer deal, the Chevron Hess deal. And I would say that, what we're going to see here is then fragmentation. So I think that, yes, there are private capital, private companies backing out of the space, but there's new money coming into the space. And so to the extent that these consolidators now divest in smaller packages, and we see new companies come in and take these opportunities, they will need capital. I always say, at EIG, we can be a first partner capital provider so companies that don't have access to the banks, and we can be a lasting partner. And so we've done acquisitions we've done acquisition financing where we have relationships with the company, and then we continue to grow and scale with them. And I think these are unique opportunities, but they have to be alongside good origination and continued good diligence.
Okay, fantastic. And I think you've alluded to it there as the next question I was going to come to around trends of industry consolidation, the types of opportunities that presents to private equity firms like yourselves. The question that I have is, consolidation is expected to continue. Companies are obviously fighting for scale, for relevancy in the public markets. How does a firm, looking at the opportunities that presents to private markets players and smaller independents, how does a PE firm like EIG go about approaching this scenario? Does it change your investment approach towards upstream at all? Is the play nowadays to build a portco to a point that you can exit? Is it a case of, and if so, how do you go about doing this? What's the approach? And I guess it comes back to this theme of, we've seen investors really calling for discipline, I suppose, with companies obviously generating free cash flow, maintaining operating and capital financial discipline. Is that competing with the opportunity set that's going to emerge as a result of consolidation?
I think it's a good question. And I think that there's a few things at play here. One, we need to be patient. So the last year and a half, when we saw massive consolidation, it's not necessarily the place that EIG or private capital is going to play. We've also seen tons of public capital come back to the space because you're seeing full loan books come out. You're seeing the capital markets being wide open. There is available capital at sometimes a lower cost. And so companies are going to try and take that capital first. And so it's very important that we are patient. And in that last year and a half, we've done deals, but I would also say we've been in an era of paying our LPs back and realizations. And so we've seen some very healthy realizations from companies where our investors are happy to get that money back and be able to reinvest it. Now, I think we're going back into this, as I mentioned, it's going to fragment again. We're going back into this era where we can reinvest and deploy. And so there will be opportunities, as we saw on the panel, there will be opportunities to invest in acquisition financing, but we need to be very patient and very disciplined in our diligence to make sure that we don't get greedy to just deploy capital, so that we can give that consistency back to our investors with the returns and being smart with the teams that we invest in and the assets that we're investing in as well.
Yeah, no, makes perfect sense. And I think another theme that's come up is that around resource scarcity, declining productivity, and sort of how companies and investors are building out future runways. I mean, what basins matter outside of the Permian? As companies run out of this high quality inventory in the Permian, where do they go next? What opportunities does this present? And what is the new tier one rock that companies are trying to acquire and drill up?
It's a great question. It's a great question because we're talking all about acquisition financing, but there's also this development financing piece of it, and what's going to be developed, And so, we've provided structures to companies that we think are very compelling that aren't necessarily a drill co, but it's very, it's investment grade companies or good quality companies that when they look at their portfolio rationalization, there's opportunities that are economic that are going to the bottom and that need funding, or even the middle that need funding. And so that's where a partner like us can come in. We can structure an investment that says, okay, maybe this isn't Wolfcamp or Bone Springs or the targets that we know, but we have got to be developing these tier 2, tier 3 plays to continue being a net exporter. It's so critical. And so, back to the question, what basins, what plays are going to, be important? I think Permian continues to be important. It's obviously a very expensive basin to get into. It's a very competitive basin to get into, and people are really paying up for undeveloped locations. And so I think it's still basins like Eagle Ford. Lots of consolidation still needs to happen in Eagle Ford. And we're seeing it, but when we look at number of operators and production, and we just plot those two things on a graph, you can see a lot of operators in a basin like Eagle Ford with low production. It's just screaming that consolidation needs to happen. Or, let's continue developing the Austin Chalk or whatever that next bench is. I also think it's, basins like PRB, which for 5 to 10 years, we always thought was the next Delaware Basin and never really played out. But there's resource there, and there's a lot of companies with low production. Again, there's going to be consolidation in those types of basins. I think finally, natural gas, as it continues, the LNG story continues to play out, I think we'll start to see some activity in Appalachia and basins like that. But we need the gas strip to play out, and we need the LNG story to play out to start to see financing needs really, I think, bubble up in those types of basins.
Great. Well, lots to keep a lookout for, but thanks for your time, Jeannie. We'll look forward to following your progress, keeping in touch, obviously continuing the conversation, but great chatting with you always, and look forward to the rest of the day.
Thanks, Ben.